Good morning. Good morning to you. Welcome to this edition of Coffee with Counterpoint. I would just like to introduce today's panelists. Brian Pyle, Chief Investment Officer of Counterpoint; Ian Anderson, Portfolio Manager and Head of our listed property business; and Piet Viljoen, Portfolio Manager and also Director of Counterpoint. It's a great pleasure to have you with us this morning, and today's discussion is going to be a little bit different than previous Coffee with Counterpoints. We're going to be talking a little bit about the business, and then delve a little bit into the question of industrial change within the investment management industry, and particularly some questions raised around mergers. It's been a popular question. It's been asked to us in recent times. And so we thought we would take the opportunity today to address that particular topic. Of course, if you do have any other questions relating to financial markets or portfolios, you're more than welcome to ask those questions in the chat box, and we will endeavour to answer those questions as we go through the session. And just for housekeeping purposes, the best possible experience for GoToWebinar will be that you close down all other applications so that your voice and video quality remains as high as possible through the session. So yes, thank you again, and I hope you enjoy today's session. Incidentally, between the four people online today, we've got around 110 years of combined investment experience. We've all been in some nasty battles with financial markets. We've got a few scars. We certainly don't have all the answers, but I think Counterpoint certainly benefits from the combined skill and knowledge and experience of the individuals online today. And I think that's particularly important given where we find ourselves in the world at the moment, with an enormous amount of volatility, lots of uncertainty around the direction of interest rates, and a lot of industrial change too going on. So we're very pleased to have such a strong lineup of investment professionals with such deep pools of experience. So just a brief slide just on Counterpoint and who we are for those of you who don't know the business. We do have quite a few people online today that don't have a lot of background with the business. So we're a multi-strategy asset management business. We're a boutique in the sense that we're a smaller asset manager. We don't have size constraints, and we are focusing on various disciplines where we believe we have a competitive advantage. We manage money in both the unit trust, CIS, as well as segregated accounts for certain large investors. We have a Category 1 and 2 FSP license, and we have 23 staff situated across 3 offices across South Africa, the main office being in Cape Town. We also have a Durban and Johannesburg presence. We as a business focus 100% of our efforts on managing money. We obviously do have support and operational staff within the business too, but where possible, we've chosen to outsource non-core operations to third parties. So our unit trust funds are outsourced to Sanlam Collective Investments domestically, Sanlam Asset Management Ireland globally for our global equity fund, and we've also got a relationship with JTC and Guernsey for our global value fund. And we also have relationships with Signia Life and 27/4 Life, where our funds are pooled and wrapped on the life licenses of those 2 organizations. That allows us to remain lean as a business. So of that 23 staff that I mentioned there, 12 of our staff are investment decision-making staff. So we've got more than half of our staff are actually looking at portfolios and making decisions towards that end up in portfolios. The businesses are audited by Mazars, and our compliance is outsourced to a large national compliance practice called CompliServe. I'm sure most of you are au fait with CompliServe. And our funds are also available on all the major list platforms as well as selected umbrella fund platforms. And as at the end of April, the business has got 9.2 billion rands in assets under management, and that's a very clean number. We don't double count assets at all, so the number would be larger than that if we do have some double counting, but on a look-through basis, 9.2 billion of clean assets. In terms of the group structure, we have introduced the shareholding structure over time. The previous, or the shareholders are split across two predominant entities, being Merchant West Holdings, who are now our dominant shareholder with 53% of the equity. ReCM Asset Co, or ReCM Holdings, owns 34%, and then Sterling Private Wealth owns 20%, but Merchant West in turn owns more than 50% of Sterling. So we actually count those Sterling shares at the top level with Merchant West. So Merchant West is a large Joburg-based financial services company with offices all around South Africa, as well as Namibia, and more recently in the US. And they have a very strong shareholder reference for the business and are committed to supporting and growing Counterpoint through time, and that's particularly important for a business that operates as a boutique asset manager within the context of the South African investment industry. We have done an enormous amount of work in the business since we amalgamated the ReCM and Bridge businesses back in 2020. And, you know, for the last 18 months or so, the predominant focus of the business has been on the area of the investment team. You know, we've brought some new and highly skilled investment competences within the business. That started with Daniel King joining us as head of fixed income. We then brought Brian Pyle in as the chief investment officer. Rudy van Niekerk has joined us recently to work alongside Pitt in the value strategy. We've developed a quant capability, and Crana Stradum is assisting us in that area. And more recently, Alyssa Viljoen has joined us as an equity analyst. So we've spent a lot of time beefing up the investment team. I think we've got a highly skilled and well-resourced investment team now for a boutique investment management business. And then in the last 6 months, you know, I've started to spend some time with Jaco Brandt, our head of distribution, and the gentleman who normally hosts these sessions, in focusing on our distribution capability, and broadening out distribution and the marketing competence. So Roberto Doe are in the distribution side. Johan Wenzel will join us on the 1st of June as an additional distribution resource in the Western Cape. And then Mandy Abrams has joined us as our head of marketing, and Bridget Hendricks looks after our advisor and client support. And then, you know, other areas of the business, you know, Sandy Ven's been our financial manager for many years, and her team offer sort of overall general support to the business from a finance and operations perspective. And I think the changes that we made in the business have allowed, you know, clarity of roles, and, you know, just creating some lanes in which, you know, our investment professionals and our distribution staff and operations staff can swim. And I think, you know, from a business point of view, when you amalgamate businesses together, you do tend to have people that are operating across the business, and you gradually need to find a little bit more focus for those staff. And so we've been working very hard in getting that done over the last few months, and, you know, I'm very proud of what we've achieved in this regard. And then, you know, we've also spent quite a bit of time thinking about our multi-strategy business framework, and you know, how we're going to assist the investment team with research, both at a fundamental and quantitative level, to support the investment capability. So, and we've got the 5 distinct investment strategies that you see there. So fixed income, outcomes-based strategies, the payers and growers, which Ian Anderson and Richard Hen would have looked after for more than a decade. We've got our multi-strategy core portfolios, which are, you know, sort of regulation 28 portfolios that we're measuring and managing against, you know, the large well industry balanced funds. We've got our quality business that Ray Shapiro has been looking after for several years, and then our value strategy, which Pitt, Rudy, and Daniel look after across the global and domestic portfolios. We also have made several changes to different portfolios. We've recently changed the name of the preference share fund to the flexible income fund, and you would have received the communication in that regard. And we're also in the process of closing down our moderate fund, and those clients have been shifted either into the cautious or the balanced plus fund. So just neatening up the product range, and I think we've done an enormous amount of work in this regard too. We will spend a little bit more time, and I'm sure in the course of today's Q&A, Brian will be talking a little bit about the fundamental and quantamental research capability which he's building within his team. But we're very proud of the progress that's been made within that aspect of the business in a relatively short space of time. And as I say, we'll talk about that a little bit later on. But the essence of today's presentation was actually raised, as I've mentioned in the introduction, through various interactions we've had with clients, people regularly contacting me to ask me how the merger and the amalgamation has gone. And it was, an article that was written in the Citywire by Stephen Cranston in early January of this year that referenced an industry stalwart, Neil Brown, saying that he, and quoting in several places, saying he had never seen an asset management merger which worked. And this needs to be seen in the backdrop of a massive amount of M&A activity that's going on within the global asset management business or industry, and we believe that there's going to be increasing M&A activity within the South African industry for a variety of reasons. We've got increasing a share of the industry that's going to the passive business. We've got a lot of money, particularly now with the new regulation 28 and CISCA regulations permitting asset managers to take up to 45% of their assets offshore. And we think that this gradually just means that money is going to leave the South African investment industry, and it's going to put increased pressure on asset management companies, not just smaller ones. In fact, all asset managers that are perhaps break even or close to break even. And so we think financial advisors are going to be confronted with the notion of mergers with industry, whether they like it or not. And we thought it would be a good opportunity just to talk about the issues that you would need to think about as financial advisors or as clients, where asset managers have gone through a process of amalgamation. And I think there's really a couple of areas if you have to look at adjudicating whether a asset management merger was successful or not, there'd really be 5 areas. I mean, the first one is, has the business been able to be stabilized? I mean, there's normally good reasons why asset management mergers occur, and the first is normally because businesses have actually got to break even level, or perhaps are even unprofitable, given the minimum cost base that asset management companies have to incur around regulatory costs, systems costs, people costs. You need to have a minimum number of assets just to actually make the business profitable. So does the merger actually stabilize the business? And I think the second point is, have the clients been retained? And fortunately, in the case of Counterpoint in our merger, we retained an overwhelming majority of the clients. We've been fortunate enough to pick up a few new clients in the last 12 months too, so we're very pleased with that. The third thing that I think you would need to look at is, have you been able to attract new talent? So is this merged business an attractive proposition for any new talent coming into the business? And once again, we're very pleased to have been able to attract 5 new people to the business, high quality people over time, and we'll talk about that a little bit later on. The fourth thing that I think you need to look at is the business more or less profitable? And profitability and sustainability is a key consideration. We're very pleased in the Counterpoint sense. We've had a record year. Our financial year ended on the 31st of March, and we had a great year. So certainly from that aspect, our merger certainly appears to have worked. And then finally, and I think perhaps more importantly, the way investors often measure asset management businesses is on the quality of the outcomes that they produce. And so, we've taken the performance of the business, of its CIS funds over the last couple of years. The 3-year chart there predates the merger, and obviously, the 2 years and shorter periods of time are the period of time in which we've actually been working together and integrating the businesses. And we're very pleased that the shorter term numbers of the 1 year, all of our funds are in the top 2 quartiles. We've got no funds over the last year in the bottom 2 quartiles, and that's clearly a function of markets recovering and the business being well positioned in relation to that. So I think all in all, I certainly wouldn't say that we out the woods, that the business is perfect, but I think that the evidence across various different measures for me tends to suggest that the merger of Counterpoint, Recium and Bridge Fund Managers into a combined entity is demonstrating that we're actually on the right track and the business is moving and has moved in the right direction. And for all intents and purposes, most of the unsettled things that we experienced are behind us, and we're looking forward and growing the business now. So we're very pleased with that, and we're working very hard to make sure that continues into the future. So with that as an introduction, I think it's just worthwhile then starting to bring in the panelists and to ask a couple of questions from each of them in relation to their experience of the industry and their experience of mergers. And my first question is going to be to Brian Pyle, who joined us in August of last year. And Brian, I think you and I spoke a lot about this, prior to you coming on when you were assessing Counterpoint as a business. And you came from a large, very well-resourced investment management business that was very much a corporate asset manager based in Pinelands. So from your point of view, when you joined Counterpoint, what were your expectations around the business? What were your expectations around what you would experience within Counterpoint? And how far do you think we've progressed in that journey in relation to your experience of working for that large corporate manager for well over 20 years? Maybe to give us some thoughts on that, please.
Thanks, Paul, and good morning to everybody. Thank you for your time this morning. Paul, I think it's probably, if I split the answer into 2 buckets and say, what are the things that have surprised me on the upside and what has surprised me on the downside? I think it's fair to acknowledge that on the downside, we're not the completed product yet in terms of investment process and systems. I think we've still got quite a long way to go in terms of bedding that down. I think the reality, though, is in any asset management business, you're always tinkering and working on your investment process and your systems. I don't think you can ever say, oh, we've got to the finish line. And if you do feel that you've got to the finish line, you should probably check yourself. So, firstly, just to acknowledge that we probably have got work to do in terms of those two aspects of the business. And then on the positive side, I mean, we are a people's business, and in doing my due diligence on Counterpoint, I spent quite a long time before signing an employment contract on the people that I'd be working with. So just as much as you two guys think you were interviewing me, I was interviewing you as well. But I think we really have a really solid set of people. I think we are well resourced. We don't need any more investment people at the moment. So, to a degree, I could say we've got to the end of that finished post for now. But how do you measure good people? And I think I measure good people on the level of debate that you have inside. And I'm talking about investment debate. So it's not about whether they're nice and fluffy and nice to go out and have a beer with, but are the people you working with challenging you and challenging the investment process and forcing a good investment debate? And I can honestly say that we are at a level that is extremely high relative to what I've witnessed elsewhere in the industry. We've got to keep working at it, but we have a good deck of people in terms of curiosity, honesty, and really humble bunch. And the opposite of that is egotistical arrogance and things like that. And those are the values you don't want to have in your business. So I think we've been lucky in that we've been able to get new blood into the business, and I think the people that were in the business already were respectful enough that the new blood could come with new ideas. And I thank you guys for accepting some of the new ideas that I've put into the business and into the investment process. But yeah, there's still a lot of work to do, but we're having fun, and I think what we've got is a good opportunity ahead of us. Thank you.
So you've mentioned process and systems in your response there. I mean, just in terms of process and systems, maybe you can just expand on that a little bit more. What do you mean by process and systems for the benefit of our audience?
Yeah, I think there's two things there. It's how you debate any investment proposition. And that's process. How you debate whether you should be buying or selling the share, and are you having information meetings or decision-making meetings, and to have as many decision-making meetings as possible and as few information meetings as possible. And we're getting there. I think we're moving more and more to having more decision-making meetings and less information meetings. So that's what I mean by process. When it comes to systems, we're in a world of lots of data and a lot of information overload, and it's about using all of that information to the best of your ability, and we're doing that through the lens of a quant model, which is going to and is, I would say, we in version 1 of this prototype of delivering a model portfolio. So when we go into portfolio construction and analysis, we're doing it off the back of an intelligent, data-driven quant model and model portfolio. But it's all about, just harnessing all the data and information that's out there in the best way possible. And that's what systems and process are when I think about that.
Yep. And I mean, just for the benefit of everybody listening today, I mean, you and I have had this discussion many times. Employing 50 analysts, 50 more analysts doesn't guarantee you a better outcome. And it's about the smart use of data and the melding of data and competent humans that gives you better investment outcomes, in our opinion. So we've got the competent human beings, and it's about making sure that we use data in the most intelligent and sensible fashion, looking forwards. Pitt,
Correct, yeah.
you've been a stalwart of the South African investment industry, for many years. I worked together with you just after you started RECM back in 2003. You've seen the inside of large asset managers. You've grown your own business. You've seen fads come and go, and various asset management companies come and go, frankly. So, drawing on your experience of over 3 decades, managing money, if you have to sit down and write a book or a thesis around this, I mean, what do you think are the kind of core ingredients that make a investment management business successful? What are the things that come to the top of your list?
Yeah, morning. I think that's a key question, and it basically boils down to the 3 Ps. When you buy a house, the estate agents always tell you position, position, position is what you want to look for. The 3 Ps. Well, in fund management, I think it's a similar thing. It's people, it is product, and it's performance. Those are the 3 key ingredients that a successful fund management business needs. When we talk about people, you're actually talking more about the culture of the business rather than the specific people. Of course, this industry is filled with very smart and capable people. What differentiates one firm or a successful firm from maybe a less successful firm is the culture within the firm. And that is something that we are still working on. That's a work in progress. But it is from where we started, it's over 2 years ago now. When you looked at the 3 individual businesses that makes up today's Counterpoint, I think we have a much stronger and a better developing culture than any one of those single individual businesses. And at the end of the day, culture trumps strategy all the time. So that's something we work on very hard. And we have a bunch of people in this business today who want to be here and who understand where Paul and Brian want to take the business and buy into it. And I think that's key. So that's the people part of the business. The second important ingredient for a successful fund management firm, I would say, is having the right product to offer your clients. If you come to the market with just another Me Too benchmark-oriented fund and you think you're going to compete with Allen Gray, Coronation, or 91, and with that sort of thing, I think it's a lost cause. Then you should rather just index your money in any case. Indexing makes much more sense. I think the product or the strategy that we offer makes sense to clients, and they fulfill a need for clients. If you look at our pay as and grow strategy, that focuses on income and the growth of that income. And that's a large portion of South African investors need income, and they need that income to grow. And that's what the pay as and grows does. And it's a niche strategy. It's something almost nobody else does. The second strategy we have is a value strategy. I think the Counterpoint Value Fund, both global and local, is one of the few value funds left in the country. I think most investors have abandoned the value investment philosophy, of course, just in time for it to do spectacularly well as it has been doing over the past while. But it is true to say that the Counterpoint Value Fund is one of the very few value funds left in the country. So for those investors that want and that buy into the value investment philosophy, we have the right product, and we've got a product that is currently the best fund over 5 years, equity fund in South Africa over the past 5 years. So that brings me to the third point that a successful fund management firm needs is performance. And I think our performance has turned the corner. It's not going to be a straight line up. I think Paul showed the chart over 12 months. All our funds are top or second quartile, all our strategies. I think it's a good start to a merger to have all the funds in the house doing reasonably well and delivering to clients' expectations. So I think we're getting there. I think the investment process that Brian is building into the firm is working. Again, it's a work in progress. It's not the finished product by any stretch of the imagination, but we're on the right track, and I think the performance numbers show that. So those are three things. It's the people, the culture. It's the product that delivered to clients' expectations in terms of performance. Those 3 Ps, I think, are the key ingredients.
Yeah, thank you for that. I mean, I agree with all of those points, and you mentioned culture as being critical, and yes, it is something that we're working extremely hard on, and to some extent, culture also evolves and develops, over a period of time, and so it's a combination of making sure that you have an ethos within the business that everybody subscribes to, and then you've got to allow time for that ethos to permeate through the business, and the fact that everybody wants to be here, I think, is a critical part of that. So yeah, it's always valuable to have people like yourselves that I can bounce ideas off to, and I think that will benefit our clients over a period of time. Ian, moving on to you, you've been involved in the management, and Pitt referenced the Pay as and Grows strategy has been very unique offering within our overall product capability at Counterpoint. Actually, even prior to your time at Grindrod stroke Bridge and now Counterpoint, you managed money in this way at Marriott for many years, and you've been looking after that the Pay as and Grows strategy. I think you coined the term Pay as and Grows back in a moment of inspiration about 7 or 8 years ago. So you've been doing this for comfortably over a decade now. From your point of view, what have the benefits of this merger been as a portfolio manager and as sort of an individual, in reference to where Bridge perhaps was, prior to the merger? Can you talk a little bit about that, if you don't mind?
Yeah, absolutely, Paul, and good morning, everyone. I think the first thing that I would say is that I'm having more fun and I'm spending more time managing money, and I think that was probably the most critical outcome for me in terms of this merger. So if I just think about it from a very personal perspective, I think about the structure that we had at Bridge. There was quite a lot of administrative functions that were done by Bridge internally. We had our own manco, and that comes with a significant amount of responsibility, a significant amount of oversight. And although we were lean and mean, there were still distractions. There were times when you would want to be focusing on analyzing a particular business, but you were dealing with something that might have been going on within the manco. So I think one of the big issues or one of the big learnings from our time at Bridge was to maybe move away from doing a lot of that ourselves, outsourcing that, and then just relying or just focusing almost exclusively on the investment management process and actually managing money. And then I think the other really big difference is that although we had a reasonably robust and well thought out investment process within Bridge, we've expanded on that, and we've got something even better today. And so I'm drawing on that investment process. I'm drawing on the ideas that have been generated by a much larger team and people with very different or a different way of looking at investment markets, a very different a way of looking at investment trends or looking at companies in a very different light. Drawing on that inspiration and applying it where I can into our portfolio. So I think the most obvious example of that is, at Bridge, we didn't have a dedicated fixed income team like we have at Counterpoint today. And I've been able to draw on the work that Daniel and Rayan have been doing and apply it into the pay as and grows strategies. And it actually has delivered a significant amount of excess return over the last 12 months. So yeah, I do want to say thank you to my colleagues for the assistance that I've got. We've obviously had great returns, and a lot of that is a function of the market. But a big chunk of that has also come from having the sort of skills or additional skills in our business, which we've been able to then utilize and deploy in the right way. So you're not having to second guess yourself. You're going out there and you're utilizing, and it's been actively discussed in the team. So you're not worried about whether or not you're thinking about this alone. You're actually thinking about it in a team. You've hopefully done all of the deep dive that you need to do before you make your investment decision and before you pull the trigger. And I think the results are already speaking for themselves.
Yeah, and conversely, I think you managed to convince Pitt to buy a property stock too. Almost unheard of.
So that is probably the biggest debate in our business, sort of all the time. It's property. We actually had a drink last night and we were discussing exactly that.
Yeah. I must say, I really do find it extraordinarily interesting, sitting in our investment team meetings and listening to the debate. Ian, you presented to the investment team yesterday on Mr. Price, and it was fascinating to see how different strategies view the same stock and the same financial information, and what's useful and contributes positively to one portfolio based on its particular outcome might not be useful for another strategy, but at least you both have an understanding of why you would or wouldn't own that particular stock in your portfolio. And I think that's diversity across views is remarkably useful, and for a boutique, to have that capability, I think is very unusual. And that brings me to my next question, Pitt, in relation to boutiques and the boutique investment structure. It does come with inherent risks. I mean, boutiques are typically smaller. They do have some financial fragility. They often experience, a lot of volatility in their fortunes, as markets move and as their strategy comes in and out of vogue. So some people would argue that boutiques have inherent risks that maybe larger companies don't have. we've thought about this quite hard, and we're a multi-strategy business. So perhaps, from your point of view, what are the inherent benefits of a multi-strategy boutique versus a single strategy boutique, which is much more common, structure within the asset management industry?
Yeah, I think one has to look at this question through the lens of the client. What does the client experience in a single strategy firm vis-a-vis a multi-strategy firm? And I think there's two things that clients will experience. The first thing is, as you point out, a level of financial fragility in a single strategy firm. When that strategy doesn't do well, there is financial pressure in the firm. And let's be frank, no strategy does well at all times. There will always be a point in the cycle when a single strategy does relatively poorly. At that time, in a single strategy firm, the firm is under financial pressure. You might be having to let people go. You might be having to do certain things to make sure the business survives. And that means, in most cases, the investment team takes their eye off the ball because they're distracted with all sorts of other things going on in the business. Whereas in a multi-strategy firm, when a single strategy is out of favor and doing relatively well, it almost goes without saying that some other strategy within the firm will be doing well, because that is the nature of markets. And the firm as a whole will be financially sound, and the strategy, the members of the strategy, which is underperforming, can focus on what they're doing, and they don't have to worry about their future and the financial future, and is it going to fall over or not. So it takes a tremendous extra layer of unnecessary pressure off the investment team, which I think is a key outcome for clients. And I think the second thing, and it's related to that, is most single strategy firms have one or two lead decision makers, key persons, as they call in the industry. And single strategy firms have significant key person risk, not only whether these people get disillusioned and leave the firm, but they can get run over by a bus, or go over the handlebars on a bicycle and get badly injured, or anything like that. So that is a risk which is real for clients, and it's one of those risks which is either it doesn't happen or it happens, and when it happens, it's a significant event. Whereas in a multi-strategy firm, you have multiple key decision makers, and you face much less of a key person risk environment. So those are two things that I think clients should focus on and should think about as they decide whether, with which type of firm they want to deal with.
Yeah, and I mean that's a nice introduction to my next question, and that relates to, we firmly and strongly believe in the concept of of boutique firms as active managers that can make a material difference where size is not a major constraint. Over the last decade, and maybe even slightly longer than that, we've actually seen larger asset management companies that have got very large books actually trying to deconstruct those businesses into smaller operating units, multi-boutiques. And I think, there's at least 3 that are very well documented within the marketplace. And I mean, Brian, you actually worked within one of those 3 organizations that actually did the deconstruction rather than, So just from your point of view, maybe it's an unfair comment, but I'm going to make it anyway. I mean, I don't think that in the broader investment industry, any of those 3 organizations have enjoyed sort of, broad commercial success post their deconstruction. And there's been pockets of success, but not broad success. If you measure that against some of the other, very large asset management companies that have grown and become prominent over the last, 10, 15 years. So, why do you think, I mean, from your point of view, why do you think that commercial success hasn't been achieved? Do you think it's a investment specific issue, or do you think there's other matters that perhaps, investors, financial advisors haven't seen or haven't identified? Have some thoughts on that, Brian?
Paul, I don't think it's a people issue, and I don't think it's an investment capability issue. Those people are arguably very good investment managers, which is why a deconstruction is justified. But what happens is these people get out into the world and suddenly they're running a business. And good analysts and fund managers don't necessarily make good business managers. It's not that they can't do it, it's just that they don't have a passion to run a business, or they just don't have the time to run a business. And suddenly they're finding themselves doing all sorts of things where in the big organization they didn't have to do. You know, they didn't have to worry about stocking the stationery drawer with red pens and, you know, exam pads and things like that. Whereas now they're worrying about a whole bunch of other things. So the eye gets taken off the ball. And eventually those people leave because they work out that actually what they want to be doing and what they're good at doing is investment management. So yeah, it's almost the inverse of a lot of other things that we were talking about just now, the benefits of consolidation. Then the one thing we haven't spoken about is the benefit of running funds with tied-in capital. And a lot of those guys leave the big organizations not realizing the luxury they have of having tied-in capital, be it the, you know, balance sheet money from the organization they're working at, or life company money. The risk of losing those funds is very low. And you get out into the world of a deconstructed asset management company, and you've got very real risk of, let's call it untied money. And the way with which you service your clients in that world and the expectations for performance are very different. So, you know, you lose the luxury of having that tied-in capital. And I think it's a combination of those two things. There's probably many other reasons, but that's, you know, that's as I see it, the two big issues that results in, you know, a fragmented or deconstructed company, you know, not succeeding.
Ian, I mean, we spend a lot of our time as investors, and you and your colleagues in the team of analysts are looking at you know, equity businesses all the time, and you know, where, you know, acquisitions and M&A is a part and parcel of corporate life. You know, businesses grow organically, but they also grow by acquisition. And you know, we always have a strong view on acquisitions and what drives, you know, success in acquisitions within the broader, you know, commercial community. So an industrial business or a bank or you know, a property company or whatever. You know, from your point of view, if you were looking at an asset management business from an analyst's point of view, you know, what would be the key considerations that you would consider making a merger successful? What are the key drivers? And I ask this question in the context of the point I made earlier on, that we strongly believe that the global trend of high levels of M&A activity within the investment management space is going to come into the South African market. It's already here. It's already happened. We've seen several transactions happening already, and we think that the pace of those transactions is going to increase and become more rapid. So, Ian, I mean, just your thoughts on what makes a successful merger from a purely M&A point of view.
Yes, I think it's, you know, what is the motivating factor behind it? Because if we think back to the sort of 1990s and 2000, which was another period where you had quite a bit of M&A activity, and you went from a whole lot of small asset managers to some very large asset managers, it was driven by the need to gather assets. It was an asset gathering exercise. So these were successful businesses in their own rights, just looking to buy more assets. And often what they did was they cannibalized their own portfolios or cannibalized the portfolios that they were acquiring. So, you know, it would be, you know, merging two funds, merging two equity funds, and typically what happened was is a whole lot of clients from both firms would leave because they were uncomfortable about the new culture that may have been created. They were worried about the people that may, you know, the sort of casualties of the merger, and so I think that's one of the reasons why in the article you get the statement, and it's sort of a broad statement, that these mergers typically don't work because they're usually motivated by some sort of asset gathering agenda, and usually it's tied to some performance criteria that the CEO or the COO has or the CIO has in terms of how their bonus is going to be worked. And if I think, you know, what differentiates the merger that we've concluded is that there was no cannibalization. There was very little cannibalization. We've essentially kept the three businesses separate. We've just built it on top of one operating platform, one significantly better operating platform, and I think one significantly better investment process. But the businesses themselves, the investment parts of the businesses, have been left to run on their own and continue to engage with their own clients. There was probably very little client overlap in these businesses as well. So I think in terms of our merger in particular, the rationale for the merger was very, very sound, and the manner in which we put the businesses together was also very, very sound. There was little scope for cannibalization, and what we've ended up with is a whole that is, significantly more valuable than the sum of those individual parts. I do think that with the increased cost base that most asset managers experience today, these particular mergers are going to become the norm. We just see so many small asset managers with 5 or 6 billion rand in assets under management, and it's just, it's difficult to see how those businesses can continue to be sustainable, given that minimum cost that you need: regulatory costs, staffing costs, systems costs, and so I do think that if you look at the landscape, yes, it's going to continue to be dominated by 5 or 6 very large businesses, but I think all of those other businesses underneath there will either be driving some consolidation or be subjected to consolidation. And I'm sure we'll be in there amongst them. I think we've got a bit of time before we do the next one. To be frank, I think as both Brian and Peter have alluded to, there's still some work that needs to be done, and we're not through this particular merger yet. But certainly, I think the way that we've gone about it, putting different strategies onto a single operating platform, is definitely the way to go. It's like a retailer, buying a different product line, buying a different brand in a different category. If I think about the Mr. Price business, they've done exactly that. It's the sort of thing that we've done as well.
Yeah. Thanks for that, Ian. We do have, and just a reminder to attendees, if you do have any questions for the panel, please send them through. We actually got 4 questions at the moment, so I'm, 2 of them are for me, and then 2 for the rest of the team. So the first question relates to the property stock. The person wants to know, what property stock did you manage to convince Pitt to buy in his portfolio?
Well, there were 2. There were actually 2. The one I wouldn't say Ian convinced me to buy. That was just a deep value situation in Rebosis, and I wouldn't recommend that to anyone with or that are investing for widows and orphans. That can go any way. But the other one is well, it's a stock we're still buying at the moment, but it's a much more of a larger, more reputable property company. Not that those 2 words belong in the same sentence, but, it is a reputable property company, one of the few. And once we finish buying, then I could probably disclose the name of it. At this point, I don't think it's a good idea. I'm still buying.
That's I agree with that. The second question is posed to myself as the managing director of the firm, and it relates to Counterpoint. The question is: Counterpoint lost some senior staff in 2021. How has this impacted the business? So it's a good question, and I think the reality is that in any merger, one of the major benefits of a merger is that you have cost consolidation, and you have a new strategy for the business that has to be agreed upon by all of the key role players. And so we had to make the shareholders had to make some tough decisions around the best ways forward. And I think in the context of the two senior staff that left the business, it was more about the direction that the business was heading in, versus the business in itself. And I think we remain friends with the people that left the business, and we sufficiently staffed and the business is sufficiently resourced, that those departures of staff didn't have a material impact on the business. And actually, to the contrary, it obviously provided the opportunity for new thinking and new people to come into the business. And I think those new staff have all been well received. So whilst it's never nice to have to say goodbye to senior parts of the business, it is a reality of mergers that people make decisions about the future, and it's not going to change in any future acquisitions that the industry is exposed to, or that we might be exposed to. The second question.
Possibly add to that very quickly.
Sure.
It's a key point. The senior people that left us were all very good people, but they had different ideas about the future of the business, or their role in the future of the business. And as I said earlier, to build a business and to build a culture, you need people to buy into the vision of where the business is going. And the business is then, if you have people who don't buy into that vision, then the business is better off without those people. And that's exactly what has happened. Those people are good, and as Paul says, we remain friends with them. It's just we had different visions for the business, and therefore we had to part ways. And the business and its offering to the clients is what's important, not the feelings of individual people.
Thank you, Piet. The second question relates to BEE. Obviously, the question arises from the organogram that I put up in the business early on, and maybe even the representation across the panel today. So the question is, what is Counterpoint's view on BEE? Once again, a good question. From a previously disadvantaged background point of view, a third of our staff and some senior staff come from PDI backgrounds. Counterpoint believes strongly in the concept of diversity, but really the result of our sort of mergers over the last couple of years have meant, by definition, that the people in the business are the people that have been around the business for a long time, and we happen to have been in the business. I've mentioned 110 years of combined experience earlier on. So we're working quite hard on BE. It's something that we actually think is important, and where we're interviewing new staff, we certainly are trying our level best to try and find appropriate BE candidates for the new roles that we have. But we're not going to employ people just for the sake of diversity. We think that the best person for the job, we very much run a meritocracy in the business. And when we find the right people, we'll employ the right people in the right places. So so we've got a very, we really value diversity. We think it's important. We recognize that it's an area of improvement for the business, and we will work at that at a pace at which we can afford, and which is good for our business and for our clients. We've got another question that's come through in relation to the property business. So the question is, sticking to the property theme, with a few results being released, what do you think the underlying fundamentals on the local side are improving, or is there still a lot more pain and consolidation to come? I think it's probably a question that's aimed at yourself.
I can try that.
Yeah. I think we've seen a stabilization. I certainly don't think we've turned the corner, but that sort of the rapid decline that we'd seen or had been seeing in occupancy levels, in market rentals, I think that has slowed somewhat. There's still some ways to go, particularly for office and sort of large concept retail. I think if as we have done, if you've been focused on things like industrial warehousing, convenience and neighborhood retail. You know, if I just look at some of the trading density numbers that are coming out of that category, I mean, the fundamentals are better than they've ever been in convenience and neighborhood retail. We're seeing trading densities which have moved from about 30,000 Rand a square meter to well over 40,000 Rand a square meter. It means that they can drive through higher rentals. So if you've been focused there, you've been okay, and that's clearly what we've done. And then also things like self-storage and a Western Cape focus. There's no doubt that the Western Cape is recovering a lot quicker than the rest of the country. We can see it even in the office market and in the retail market as well. So certain pockets are in better position today than they were probably even in 2019 and 2020. But big chunks of our office market, particularly in Gauteng and KZN, big chunks of the retail market, again in Gauteng and KZN, remain under some pressure, albeit that pressure has eased. We are, however, expecting very strong improvement in distributions in 2022. So we anticipate that across our property portfolios, we'll see somewhere between 30 and 35% increase in distributions or in dividends, and that's more a function of dividend payments being resumed and maybe less cash being retained by these businesses. So payout ratios moving from 75% back up to 85 and 90%. We think the days of 100% payout ratios are gone. But we do think that the sort of normalized rate will be somewhere between 85 and 90%. These companies need to retain about 15% of their cash earnings to plow back into their properties in order to maintain those values. Obviously, it's a different number for different property types, but I think the average is around 15.
Thank you, Ian. We've got 2 minutes left, so one final question. Pitt, I think this is probably going to be aimed at you as the ex-bond guy. There's been much talk about stagflation. What is stagflation and how could it affect my clients' investments? Do you want to have a stab at that, Pitt?
I guess stagflation refers to what happened in the 70s globally, where you had very low growth rates, economic growth rates, coupled with high inflation, which meant that in real terms, consumers and economies were going backwards. And it wasn't a great time to be invested in many assets. However, I would point out that nobody knows whether we're going into stagflation or not. That is one possible future outcome, and there are many different possible future outcomes as we stand here today. I think the job of a portfolio manager is to build a portfolio which is robust to different future outcomes, because the one thing we as fund managers have proven over time is that we are not good forecasters of the future. But I think a sensible portfolio manager can build a portfolio that can withstand an economic environment that is characterized by stagflation, but that has other elements of the portfolio that can benefit from other types of economic environments, like possibly inflationary boom. That can also happen. You can have a debt deflation. There's all sorts of futures possible as we stand here today, and I think your portfolio should be tilted towards those situations which the market is underappreciating, in other words, where the consensus isn't yet, because those assets will be undervalued, and tilted away from where the market consensus is, because those assets will fully reflect that consensus and probably be fairly to fully valued. And so doing, you can build a portfolio which is robust to any potential future economic environment, not the one that you might forecast, because you're probably going to be wrong on that. Well, I will in any case.
Yeah. Super, Pitt, thank you very much. There are 1 or 2 more questions. We have run out of time, so we will be getting back to those individuals that asked those questions directly. So apologies for not answering your questions online, but I promise you we will get back to you with an emailed response to your question. Brian, Ian, Pitt, thank you very much for your time and for your thoughts this morning. It was much appreciated, and most importantly, to all of the attendees this morning, we sincerely appreciate your time. We know that it's valuable. We know that you've got lots of options and webinars that you can attend, so we are immensely grateful that you've chosen to spend the last hour with us at Coffee with Counterpoint. The next Coffee with Counterpoint will be in, I think it's 3 weeks' time. The invitations will go out in the not too distant future from Jaco and his distribution team. So with that, it's 10 o'clock exactly. Thank you very much for your time and good day.
Yes, thank you.
Thank you. Goodbye.
Bye. Thank you.